In this video, we're going to look at the determinants of expenditure for investment purposes as well as net exports. First, private investment. Potentially, there are a lot of variables that could affect investment, and let's examine them one by one. These variables are real interest rates, real income, expected growth of income or expected future growth, and technological change, new technologies becoming available, and finally tax rates. Let me introduce this discussion by first focusing on the fact that investment must depend on real interest rate, not nominal interest rate. Let me introduce this topic by focusing on an example. There's a project for building a rental house. It costs $100,000. You figure out that if you build a house, rent it out, you're going to get $6,000 net of taxes, hassle, etc. You expect the inflation rate to be 2%, and you go to the bank to borrow money for this project, and the interest rate turns out to be 7%. Now, think about this question. Can you make a profit by investing in this project? Those of you who answered A, yes, are correct. Let's see why you're correct. It's true that every year you're going to be paying $7,000 while you're earning $6,000, so your cash flow is going to be negative. However, notice that the price of the house is going to go up by 2%, which is $2,000 based on $100,000 value, and therefore you're going to earn $2,000 by way of capital appreciation. If you add that to your rental income, that becomes $8,000, and that's more than what you pay by way of interest. In other words, investment decision should be based on expected return on the project plus expected inflation, which is a kind of capital gain. And as long as the sum of the two is bigger than nominal interest rate, it's worthwhile to invest. Writing this inequality slightly differently, expected annual return of the project should be bigger than nominal interest rate minus expected inflation, which is real interest rate, as we've seen in a previous course. So the important implication of this example is that a rise in expected inflation could actually boost the investment. We're going to come back to this, and we're going to see the significance of this effect. So we learned that investment depends on real interest rate, and the effect should be negative. As real interest rate goes down, investment should go up. It becomes less costly to invest. If the interest rate goes down, cost of borrowing goes down, a lot more people will find it worthwhile to invest, or investors will find a lot more projects worthwhile to spend on. So we're going to see an increase in investment when interest rate goes down, and vice versa. If interest rate goes up, we're going to see investment goes down. And we can follow the locus of the points that represent the combinations of interest rate and real investment, and that gives us a line which we call investment demand curve. So we've seen that interest rate has an inverse relationship with real investment. You might say that income should also be affecting real investment, so that should be another variable to be included in the investment function. But actually, current income may not have much of an impact on investment. The reason is that investment is forward-looking. People invest for earning income, earning profits in the future. If our current income goes up, that may be indication that the economy is peaking and they should be actually investing less. It could be also an indication that the economy is doing well and will continue to do well. What matters is what people think about the future, not what actually happens right now. Now let's look at other variables that might be affecting investment. Let's start with the investment demand curve. Suppose that the investment demand curve is the way it's presented here. And let's say that people become more optimistic about the future. So at every given interest rate, they would like to invest more. The same effect could come about if technology improves. In fact, one of the biggest drivers of investment is technological change. When a new technology comes about, you can make more profit by employing it, and that's the time to invest. That is the main driver of investment in the long run. So for interest rate R0, if investment is initially I0, it becomes I1, a higher level, and similarly for every other interest rate. This means that this whole curve is going to be shifting to the right. And we're going to move from I0 to I1. Another relationship between interest rate and real investment. Inversely, if people become pessimistic about the future, they invest less at every interest rate, and the investment demand curve shifts to the left. The final variable that we're going to be looking at is the tax rate to see whether it affects investment. A lot of people naturally think that raising tax rates should reduce investment. The relationship, in fact, is more complicated. Let me explain. It turns out that if we tax the total revenue and total income, taking account all the details of the project, both on the revenue side and the cost side, then fixed tax rate should not have much of an impact on investment. This is why. Let's suppose that the tax rate is tau, and total profits calculating all the costs, all the benefits is pi. After tax profit is going to be 1 minus tau times pi, right? So if you're a business maximizing profits, you're going to be trying to maximize pi if you don't pay any taxes. If you have to pay taxes, you have to maximize 1 minus tau times pi. But notice that the level of investment that maximizes 1 minus tau times pi is exactly the same as level of investment that maximizes pi, as long as tau doesn't change. You're just taking a portion of the profits and we try to maximize it. Whatever investment level maximizes the total profit maximizes the portion as well. In practice, however, tax laws do not apply to all revenues and all costs. There has some, they miss some revenues, they miss some costs, and as a result, it becomes a little bit messier than the simple theory suggests. For example, profit taxes may discourage investment if they apply to total capital appreciation and don't take into account the effect that inflation has on raising the value of assets. There's some more complications here because governments realize the distortionary effect of taxes and have additional laws, additional procedures to deal with it to some extent. For example, in many countries, such as the United States, the government offers investment tax credit exactly to deal with this kind of problem. So this counteracts with the distortions caused by profit taxes and other laws, and it's not very clear whether the tax rate is discouraging investment or not. On the whole, we're going to assume that taxes do not have much of an impact on investment. The final component of GDP that we will be examining to figure out what determines expenditure on GDP is net exports. Potentially, net exports depend on real exchange rate, as we've seen in the previous course. Real income of the country should have an effect on net exports, and similarly, the real income of the rest of the world, or foreign income. Let me start by graphing the impact of real exchange rate, which I show with epsilon, equal to nominal exchange rate E times price level domestically divided by the foreign price level. So if I want to graph this, I put net exports on the horizontal axis, real exchange rate on the vertical axis, and we get a downward sloping demand curve like this. The higher the real exchange rate, the less competitive our firms are, and therefore our net exports go down. If our real exchange rate goes down, then our firms become more competitive, they can export more and compete better with imports, and as a result our net exports go up. Let me ask you this question now to start examining the impact of real domestic income on our net exports. So if our real income goes up, what do you expect? Net exports to go up or down? Normally this should be a downward effect. Let's see why. As our income goes up, we spend more, and some of it falls on imports, so we import more. We don't necessarily export more because our exports depend on our real exchange rate and the ability of foreigners to buy our goods. So as long as our real exchange rate is given and our income goes up, then our exports don't change, our imports go up, so net exports should go down. And this is true for whatever real exchange rate we start with. As a result, the whole net export curve should shift to the left. If our income goes down, the curve shifts in the other direction. The final variable I want you to look at and think about is foreign income. Guess, if foreign income goes up, what should happen to our net exports? Should go up, right? And the net export curve should shift to the right. So this wraps up our discussion of the determinants of components of expenditure on GDP. We have, in the previous video, we've looked at the role of various variables in determining consumption expenditure. We looked at the impact of a series of variables on investment, on net exports, and remember that we took government expenditure as exogenous. In the next video, we're going to put all these variables together, all these components together, and see what determines GDP as a whole.